Hey everyone! Welcome to our channel, where we bring you the inside stories of the world's most powerful industries. Today, we're answering the question, how does the world trade money? It's me. Let's get started. Before we can talk about high-speed trading algorithms, we first have to travel back in time to answer the very basic question, what is foreign exchange? Simply put, Forex or FX is the global marketplace where you can buy, sell, and exchange one country's currency for another. The reason this exists is because there are countries all over the world, all with their own currency, and there's a lot of business conducted between them. If we want to sell something to somebody overseas, they lines need to be able to pay us in their own currency rather than learning how to use our currency. And since they don't carry around wheelbarrows of cash, they'll need to exchange their money for ours, either directly or through the use of things like credit cards, checks, and other instruments. Now that we know what it is, let's see how it developed throughout history. Number 1. Ancient beginnings. The first currency swaps. Long before anyone heard the word Forex, merchants were already exchanging value across borders. In places like Mesopotamia, Egypt, China, and the Indus Valley, people used a system called barter, where they would exchange one good or service for another. For example, if you had a cow and needed some wheat, you would go to a farmer and offer to trade your cow for some of their wheat. But as trade routes expanded, the problem of having to find someone who wanted exactly what you had and vice versa became more apparent. To solve this, societies began using commodity money, first shells and metal ingots, then standardized coins made of silver and gold. Now comes the first hint of Forex. As Greek merchants traveled to Egypt, or when Chinese silk traders sold goods to Persians, they needed to convert one kingdom's coin into another. So money changers, often operating near ports or city gates, performed the earliest foreign currency transactions. Number 2. The Middle Ages of banking houses and bills of exchange. As Europe entered the medieval era, long-distance trade flourished again. Italian banking families 12th–15th century. Cities such as Venice, Genoa, and Florence became international trade hubs. The famous Medici family created a network of branch banks across Europe. They even lent money to European monarchs, giving them the nickname bankers to kings. They introduced the bill of exchange, a paper document that allowed merchants to settle debts in one currency while paying in another without moving bags of coins. This reduced the risk of theft and became the backbone of early foreign exchange. Lombard Street and the rise of money changers. In London and other commercial centers, Lombard bankers established permanent tables for changing currencies and lending money. They congregated on a street now called Lombard Street. Medieval fairs, such as those in Champagne, France, became seasonal Forex markets where merchants would swap currencies to settle trade balances. 3. Early modern period. The seeds of a global monetary system, the age of exploration, and the birth of nation-states called for more organized financial systems. 1609. Amsterdam Exchange Bank. The Dutch created one of the first true central clearing banks. Merchants deposited their coins, receiving a standardized account balance regardless of the coin's quality or origin. This was a major step toward modern foreign exchange clearing. 1694. The Bank of England. With the issuance of banknotes backed by gold reserves, Britain laid the groundwork for the modern concept of fiat money, which isn't backed by any physical commodity but is tied to a trusted central institution. 18th–19th centuries. Colonial trade. As European empires expanded, trade networks spanned the Americas, Africa, and Asia. Currency exchange became a routine business for merchants and shipping companies. Number 4. The 19th century. The gold standard. In 1816, Britain adopted the gold standard, fixing the pound to a specific weight of gold. Other major economies followed over the next decades. This meant that if you had $100, you could go to the treasury and exchange it for an equivalent amount of gold. This made currencies more reliable because governments couldn't just print more money whenever they wanted to, and it also made exchange rates between major currencies more stable and predictable, which encouraged international investment and cross-border trade. A class of professional currency brokers emerged, dealing mainly with bills of exchange and gold-backed notes. The highest volume of Forex trading took place in London, nicknamed the puddle in the corner of a room. Number 5. Early 20th century. War and instability. World War I. 1914–1918, nations abandoned the gold standard to print money for wartime spending. Exchange rates suddenly floated and speculation increased. Interwar years, attempts to revive the gold standard, like Britain's short-lived 1925 gold exchange standard, collapsed during the Great Depression. Currency markets became more volatile, setting the stage for a new global monetary framework. Number 6, 1944. The Bretton Woods Agreement. In July 1944, representatives of 44 allied nations met in Bretton Woods, New Hampshire to design a stable post-war monetary system. The plan: peg all major currencies to the US dollar and peg the dollar to gold at $35 an ounce. So instead of exchanging your US dollars for gold, you would now exchange your dollars for something else that was pegged to gold, like British pounds. This agreement created a stable environment that facilitated post-war recovery and growth. For nearly 3 decades, exchange rates were fixed and the Forex market existed mainly for governments, central banks, and large commercial banks. 7. 1971. The Nixon shock and the birth of modern Forex. By the late 1960s, U.S. gold reserves couldn't cover the number of dollars in circulation. On the 15th of August, 1971, President Richard Nixon announced that the United States would no longer convert dollars into gold. Effectively ending the Bretton Woods system, currencies began to float freely, and their values were determined by market forces of supply and demand. This led to higher volatility in the Forex market, prompting new instruments and regulations to manage risks. Number 8. 1970s-1980s. Forex as a global market. As currencies floated, banks and multinational corporations needed to hedge exchange rate risk. Trading moved to major centers like London, New York, Tokyo, and later Singapore and Hong Kong. Brokers connected by phone lines to dealer rooms relayed orders to different markets. By the end of the 1970s, the market became a 24-hour global network. Electronic quote systems like Reuters Dealing, launched in 1973, allowed dealers to see live prices. Number 9. The digital revolution. Retail traders enter. The 1990s saw internet technology transform trading from telephone calls to screen-based platforms. Online Forex brokers offered leveraged accounts to individual traders. For the first time in history, ordinary people could speculate on currency pairs from their home computers. The rise of easy-to-use trading platforms and the introduction of mobile apps broadened the appeal of Forex trading. Today, the average daily turnover exceeds $7.5 trillion, making it the largest financial marketplace globally. Number 10. 21st century. High speed and high stakes. The 21st century witnessed the evolution of Forex trading from a desktop-based activity to a mobile-first phenomenon. Technological advancements, high-speed internet, and sophisticated trading algorithms have enabled investors to execute trades in real time. Here are some facts about the current state of the Forex market. Daily turnover. As of the 2022 Bank for International Settlements survey, average daily foreign exchange turnover was $7.5 trillion in April of that year. Participants. The market involves a wide range of participants, including commercial banks, central banks, investment banks, corporations, hedge funds, retail Forex brokers, and individual traders. Lot size. Standard lot sizes consist of 100,000 units of a currency pair. However, traders can opt for mini or micro lots that accommodate smaller investment amounts. Leverage. Forex trading often involves high leverage, allowing traders to control larger positions with relatively small amounts of capital. Margin call. When the value of a trader's position falls below a certain level, they may receive a margin call requiring them to deposit additional funds. Pip. The smallest price movement in a currency pair, which is equivalent to the 4th decimal place in quotes. Stop loss. A predefined order to automatically close a position at a specified loss limit. Take profit. A predefined order to automatically close a position at a specified profit target. Trading hours. The Forex market is open 24 hours a day from Sunday evening to Friday evening, excluding major holidays. Major currency pairs. The most actively traded currency pairs include HRA-USD, GBP-USD, USD-JPY, AUD-USD, and NZD-USD. Trading volume. The highest trading volume typically occurs during the overlap of major financial markets, such as London, New York, and Tokyo. Top trading centers: London, New York, Tokyo, Singapore, and Hong Kong are prominent Forex trading centers. Major banks. Leading banks such as HSBC, Citibank, JP Morgan, UBS, and Deutsche Bank are active in the Forex market. From the rudimentary currency swaps of ancient Mesopotamia to the high-speed algorithmic trading of today, the Forex market has come a long way. The advent of online trading has democratized access to this market, allowing individuals from various corners of the globe to participate in trading activities. And as technology continues to evolve, the Forex market is poised to become even more accessible, transparent, and efficient. As we look to the future of the Forex market, several trends and challenges stand out. Increased regulation. Regulatory bodies worldwide are enhancing oversight to protect traders and maintain market integrity. The European Union's Markets in Financial Instruments Directive (MiFID II) and the United States Dodd-Frank Wall Street Reform and Consumer Protection Act are examples of comprehensive regulatory frameworks aimed at promoting transparency and investor confidence. Technological advancements. Technological innovation continues to shape the Forex market. The integration of artificial intelligence (AI), machine learning, and high-frequency trading (HFT) is revolutionizing trading strategies and market liquidity. AI-powered trading algorithms can analyze vast amounts of data, execute trades at lightning speeds, and adapt to changing market conditions. Mobile trading. The popularity of mobile trading is on the rise. With smartphones and tablets, traders have greater flexibility and accessibility to the Forex market. User-friendly trading apps provide real-time market updates, advanced charting tools, and easy-to-execute trades directly from mobile devices. Increased competition. The Forex market is becoming increasingly competitive with numerous brokers and trading platforms vying for market share. This competition has led to more favorable trading conditions, wider product offerings, and innovative trading tools designed to attract and retain customers. Growing retail participation. Retail traders, individuals trading for their own accounts rather than on behalf of institutions, are becoming a significant force in the Forex market. Online platforms have empowered retail traders to participate in Forex trading, contributing to the overall growth and liquidity of the market. Cybersecurity. Ensuring the security of trading platforms and protecting against cyber threats remains a paramount concern. Forex brokers and trading platforms invest heavily in robust cybersecurity measures to safeguard customer funds and sensitive data from unauthorized access, breaches, and fraudulent activities. That's it for today. We hope you enjoyed this episode and learned something new. Please let us know in the comments section if you have any suggestions for topics that we should cover in the future. Remember to hit the subscribe button so that you won't miss any of our upcoming episodes. Thanks for watching, and we'll see you in the next one.